Picture this. You are finally buying that dream flat for 70 lakh rupees. You've gathered all your funds, signed the mountain of paperwork, and you pay the seller in full. Everything feels absolutely perfect. But you missed one tiny, crucial step. And because of that single oversight, you now owe the government a 100% penalty, straight out of your own pocket. If you just handed the seller all 70 lakhs, you've walked right into a terrifying legal trap. So let's decode exactly how to avoid this.
Welcome to this explainer for the ViewPoint. Today, we're going to take a nice slow pace and clearly decode the tax deducted at source, or TDS rules under the new Income Tax Act 2025 for property purchases. We'll be translating all that complex tax jargon into simplified language, ensuring you are completely protected in your next real estate transaction. Here is our roadmap for today. Number 1, the Rs50 lakh rule. Number 2, the hidden price trap. Number 3, the good news that no TAN is needed. Number 4, the new mandatory Form 141. Number 5, penalties you cannot ignore. And finally, number 6, warning, NRI seller rules.
All right, jumping right into part 1, the Rs 50 lakh rule.
So, Section 393 of the Income Tax Act 2025 lays down the baseline. It mandates that if you're buying immovable property for 50 lakh rupees or more, you, the buyer, must deduct a 1% TDS before paying the seller. But here is the catch, and it's a big one. This 50 lakh threshold applies to the higher of two values, either your actual sale price or the government's stamp duty value. Even if you're a great negotiator and got the price down to 45 lakhs, if the official stamp duty value says 55 lakhs, you have to deduct 1% of 55 lakhs, which is 55,000 rupees. Moving on to part 2, the hidden price trap. Now, this is where so many honest buyers make a really costly miscalculation. Let's say you're buying a new flat. The base price is 60 lakh rupees. Naturally, you might think, okay, 1% of 60 lakhs is 60,000 rupees. But wait, to actually get that flat, you're also paying 5 lakhs for car parking and 2 lakhs for a club membership. Suddenly, your total flat cost inflates to 67 lakh rupees. This means your true TDS obligation is 67,000 rupees. Calculating your TDS only on the base price is a major error.
And the law explicitly backs this up. Section 402, subsection 9 of the new Act clearly defines what counts as consideration. It legally includes club memberships, car parking, electricity or water facility fees, and maintenance advances. You literally have to add all these extra charges to the base price first, and then calculate your 1% TDS on that total combined amount. On to part 3. Good news, no TAN needed. We can breathe a little sigh of relief here because the government actually simplified this specific process for homebuyers. Normally, anyone deducting TDS has to go through the hassle of applying for a tax deduction and collection account number, known as a TAN. But under Section 397, you, as an individual buying a property, are entirely exempt from this. Your standard PAN card is completely sufficient, so you don't need any extra registrations to manage this process. Let's look at part 4. New Form 141 is mandatory. Pay close attention to this, because it's arguably the most critical administrative update of the 2025 Act. If you search the internet right now for property TDS form, almost every single website will tell you to file Form 26QB. Do not listen to them. The old Form 26QB is officially dead. Under the new Act, the only correct form you can use is Form number 141, specifically Schedule B. If you use the old form, you are going to face major filing errors. Form 141, Schedule B. Lock that in. There's also a very strict clock ticking on this new form. Rule 218, Sub-Rule 3, states that the payment of your TDS must be made within 30 days from the end of the month in which you made the deduction, and it must be accompanied by the ncome statement in Form 41. To put that into perspective, if you buy your flat and deduct a TDS at any point in June, you have exactly until July 31st to deposit that money with the government and file your Form 41. Now, after you file, you might think you're done. Actually, scratch that. You still have a legal obligation to the seller. You have to issue them Form number 13, and you have to hand this over within 15 days of your filing due date. Why? Because you took 1% of their money and gave it to the government. The seller absolutely needs Form 132 as legal evidence so they can claim that amount as a tax credit when filing their own income tax return. It's your legal duty to provide it.
Which brings us to part 5, penalties you cannot ignore.
So, what actually happens if you just ignore all these rules? This circles right back to the terrifying trap we talked about at the very beginning. Section 448 empowers assessing officers to slap you with a penalty exactly equal to the tax you failed to deduct. Meaning, if your TDS obligation was 70,000 rupees and you simply paid the seller the full flat price, you are now personally liable to pay a 70,000 rupee penalty to the government. The seller has zero legal obligation here. The burden falls 100% on you. And honestly, things can spiral out of control pretty fast. On top of that 100% penalty, you accrue 1% interest every single month for a late deduction and 1.5% per month for late payment. Even a tiny honest mistake racks up heavy monthly interest. Worse still, if the tax department determines it was a willful failure to pay, Section 476 kicks in. We're talking criminal prosecution ranging from 3 months to 7 years of rigorous imprisonment. No way is it worth the risk.
Finally, part 6, warning, NRI seller rules. Here's a massive plot twist. Everything we've discussed so far assumes the person selling the flat lives in India. If you are buying from a non-resident Indian, entirely different compliance laws are triggered. First off, that 50 lakh threshold, gone. You have to deduct TDS on absolutely any transaction amount. The rate also skyrockets to 12.5% for long-term capital gains, or standard slab rates up to 30% for short-term. Plus, you'll need a tax residency certificate and extra forms like 15CA and 15CB. You must always verify the residency status of your seller before signing anything. So, to make sure you're totally protected, here is a simple 5-step blueprint to perfectly execute your property transaction. Step 1. Calculate your 1% TDS on the higher of the base price or stamp duty value, making sure to include all those extra charges. Step 2. Deduct that exact amount from the seller's final payment. Step 3. Deposit the money using just your PAN card. Step 4. File the new Form 141 within 30 days. And Step 5. Issue Form 132 to the seller within 15 days of filing. The rules have definitely changed, and as we've seen, the cost of ignoring them is literally double your tax bill. Thanks for watching video. Share it to whom it may need it. Subscribe to The ViewPoint for more informational videos on finance, tax, accounting concepts in simplified plain English. Drop 1 comments. Are you planning to purchase new home property? Don't forget to follow the rules as per income tax. Take help of Virtual CS Services link provided. I read every comment. This is The ViewPoint.